Hi students, Namaste. This is Arjun Gupta from St. Joseph Degree College. In this session, we are supposed to discuss regarding to universal banking system. First of all, let us try to understand the definition regarding to universal banking system. In universal banking, large banks operate extensive network of branches, provide many different services, hold several claims on firms, and participate directly in the corporate governance of firms that rely on banks for funding or an insurance underwriters. Now let us see the broad meaning of universal banking. Universal banking is a multi-purpose and multifunctional supermarket offering both banking and financial services through a single window. It is a banking system in which banks provide a wide variety of financial services, including both commercial and investment services. Universal banks may offer credit, loans, deposits, asset management, investment advisory, payment processing, securities transactions, underwriting, and financial analysis. Now, let us say the universal banking in India. Universal banking is a name given to banks engaged in diverse kinds of banking activities. Under the universal banking system, the banks do broad based and comprehensive activities. The activities include making loans and advances for long term, providing working capital, corporate advisory services, insurance, depository services, brokerage, venture capital, underwriting new debt and equity shares, etc. Thus, banking system is most common in European countries. In India, SBI is practicing broad universal banking. The merger of ICICI and ICICI Bank is a move towards setting up universal banking. Hence, a universal banking is a superstore for financial products under one roof. It deals not only services related to savings and loans but also investments. There are different advantages and disadvantages of universal banking system. Now, let us see what are the advantages in universal banking system. Universal banking system leads to economies of scale. Universal banking results in greater economic efficiency in the form of low cost, higher output and better products. It enables the banks to exploit economies of large scale and wider scope. Universal banking helps for profitable diversions. The banks can utilize in existing skill in single type of financial services in offering other kinds by diversifying the activities. Therefore, it involves lower cost in performing all types of financial functions by one unit instead of other institution. Universal banks helps in resource utilization. A bank possesses all types of information about the existing customers which can be utilized to perform other financial activities with the same customers. In this kind of banking, it is easy for marketing of services. A bank with established brand name can easily use its existing branches and staff to sell the other financial products like insurance, policies, mutual fund without spending much efforts on marketing. Universal banking is one-stop shopping. One-stop shopping is beneficial for the bank and its customers as it saves lot of transaction cost by increasing the speed of economic activities. Now, let us see the disadvantages of universal banking system. In universal banking system, there is no expertise in long-term lending. These are different types of long-term loans like project finance and infrastructure finance having long gestation projects cannot properly handle by the single bank. One of the most serious problem faced by universal banking is non-performance of assets. These are the disadvantages of universal banking system. Now, let us see the operational and regulatory issues of RBI for conversion of financial institutions into a universal bank. First of all, requirements of reserve. It would become mandatory for a financial institution to comply with the cash reserve ratio and statutory liquid ratio requirements under Section 42 of RBI Act 1934 and Section 24 of Banking Regulation Act 1949 after its conversion into a universal bank. Next, permissible activities. Any activity of financial institution which is not permissible for a bank under Section 6, subsection 1 of Banking Regulation Act 1949 may have to be stopped after its conversion into a universal bank. Next, disposal of non-banking assets. Under Section 9 of Banking Regulation Act 1949, any immovable property purchased or acquired by a financial institution would be required to dispose of within the maximum period of 7 years from the date of acquisition after its conversion into a universal bank. Next, composition of the board. Compliance with the provisions of Section 10A of the Banking Regulation Act 1949, it may become necessary for some financial institutions to change the composition of board of directors after their conversion into a universal bank. Next, prohibition of floating charges of assets. Under Section 14A of the Banking Regulation Act 1949, the Reserve Bank of India may ratify the floating charges over its assets. Next, licensing. A banking license would be required to obtain from RBI under Section 22 of the Banking Regulation Act 1949 to carry on banking business in India after complying with the applicable conditions after the conversion of financial institution into universal bank. Next, branch network. A financial institution will be needed to follow with extent branch licensing policy of RBI under which the new banks are needed to open at least 25% of their number of branches in semi-urban and rural areas after its conversion into a universal bank. Next, assets in India. As required for a bank under Section 25 of Banking Regulation Act, a financial institution will have to be ensured that its total assets held in India are not less than 75% of its total demand and time liabilities in India at the close of business on the last Friday of every quarter after the conversion of financial institution into a universal banking. Next, format of annual reports. A financial institution will be required to publish its annual balance sheet and profit and loss account in the forms prescribed in the third schedule of Banking Regulation Act as prescribed by Banking Company under Section 29 and Section 30 of Banking Regulation Act 1949 after its conversion into universal bank. Next, connected lending. There is a provision to grant loans and advances on bank on security of its own shares or grant loans on behalf of any of its directors or to any firm in which its director or employee or guarantor is interested under Section 20 of Banking Regulation Act 1949. It is mandatory to comply with these provisions after conversion of financial institution into a universal bank. Next, managerial remuneration of the chief executive officers. The appointment and remuneration of the existing chief executive officers may have to be reviewed with the approval of RBI in terms of the provisions of Section 35B of the Banking Regulation Act after the conversion of financial institution into universal bank. Next, priority sector lending. The obligation for lending to priority sector up to a prescribed percentage of their net bank credit would also become applicable to financial institution after conversion into a universal bank. Finally, prudential norms. The prudential norms of RBI applicable to banks will require to be fully complied with after conversion of a financial institution into a universal bank. Students, in this session, you have learned regarding to definition, meaning, advantages, disadvantages, operational and regulatory issues of RBI for conversion of financial institutions into a universal bank. I hope you have enjoyed the session and thanks for watching the video. Have a great day.